Today, we're diving into the hidden world of private markets. This is where some of the biggest, most game-changing deals in business are happening, completely away from the spotlight of the public stock market. So let's get right into it. So let me ask you a question. What could possibly make a company's value jump by 50%? Pretty much overnight. And no, that's not a typo, a 50% premium. This single number is the key to understanding a huge shift in how wealth is being created in our economy today. The company at the center of all this is called Jamf. Now, if you've ever used an iPhone or a Mac at work or at school, there's a really good chance it was Jamf's software running in the background, making it all work. And the buyer who saw that 50% of hidden value, that was a private equity firm called Francisco Partners. All right, so let's dig into our first section here. We're going to unpack this massive $2.2 billion deal. I mean, you have to have some serious confidence to pay that kind of premium to take a successful company off the public market. So what Francisco Partners did here is what's known as a take-private leveraged buyout. It's a mouthful, I know. But the basic idea is a private firm sees so much untapped potential in a public company that they're willing to borrow billions to buy it, just so they can grow it without all the pressure of hitting quarterly numbers for Wall Street. So why Jamf specifically? Well, the logic here really has four key parts. First, Jamf absolutely dominates in the Apple ecosystem, which, as we know, is always growing. Second, by going private, the company can now focus on long-term strategy, not just hitting next quarter's earnings. Third, that crazy premium, it shows just how much confidence they have in future growth. And finally, it gave a nice, clean exit to a major early investor. It's a win-win-win. And, this deal really shines a spotlight on a much bigger trend. Private equity firms, they're also called sponsors, are looking at these solid software companies and are basically saying, you know what, the public market just doesn't get you, you're undervalued. They're placing huge bets that the real value can only be unlocked with a patient, long-term private strategy. Okay, but this brings up a pretty big question. I mean, a $2.2 billion buyout is just one deal. You need a whole financial ecosystem to support this massive, growing alternative market. So who's actually building the plumbing for all of this? And that brings us right to our next section. We're going to look at the rise of what you could honestly call a new Wall Street, a place where the lines between the public and private markets are getting really blurry and it's creating all these brand new ways to invest. If you need one clear signal that this shift is real and it's happening now, look no further than Morgan Stanley, one of the biggest names on Wall Street, buying a company called EquityZen. This wasn't just another merger, this was a landmark move. It was a sign that the private market isn't some tiny niche anymore. It's going mainstream. Now, to really get why this is such a big deal, you have to understand what EquityZen does. They handle something called secondary transactions. Okay, so imagine you're an early employee at a super hot startup. You have shares that are worth a ton of money on paper, but you can't sell them on the New York Stock Exchange, right? Well, platforms like EquityZen create a marketplace for you to sell those shares to other approved private investors. This whole thing really represents a massive evolution. I mean, the old private markets, they were like a secret club, super exclusive, hard to get into, and once your money was in, it was locked up for years. But this new private market with platforms like EquityZen and now backed by giants like Morgan Stanley, well, it's becoming way more accessible, more organized, and a whole lot more liquid. So why is this so critical? Well, first, it's part of this trend called the retailification of private assets, basically opening the door for more people to get in. Second, it lets Morgan Stanley's clients get a piece of these high-growth companies before they IPO. Third, it gives startup employees a way to finally cash in on their hard work. And maybe most important, it's a huge institutional stamp of approval on this entire market. Okay, so we've got firms taking companies private, and we've got the big banks building the infrastructure to trade them. But what happens when one of these private investments turns into a massive home run? Well, the top firms are now literally rewriting the rules so they can hold on to their biggest winners for even longer. And this brings us to an absolutely fascinating $3 billion plot twist from a firm called Stone Point Capital. They are using a really sophisticated tool that's changing the whole game of how private equity manages its best performing companies. This tool is called a continuation vehicle, or a CV. Now, the name might sound super complicated, but the concept is actually pretty simple and frankly brilliant. You see, private equity funds usually have a 10-year lifespan, and after that, they have to sell everything.
A CV lets a firm create a brand new fund specifically to buy its own best companies from the old fund. It's like hitting a reset button so they can keep growing their biggest winners.
To make this super simple, the absolute best way to understand a continuation vehicle is to just think of it like a professional sports team. Let's just walk through this. Imagine an existing fund has a few star player companies that are just crushing it, but the clock is running out on the fund, which means they have to sell. But instead of selling their star players to a rival team, they create a new team. That's the continuation vehicle, with fresh money, and they move their best players over to keep the winning streak going. Pretty clever, right? What's really cool about this is the flexibility it gives the original investors. They get a choice. They can cash out right then and there and take their profits, or if they think their star players still have a championship run left in them, they can roll over their investment into the new vehicle, hoping for even bigger returns down the line. So we've talked about a huge take-private deal, the market infrastructure being built for these assets, and a super advanced strategy to hold winners longer. Now let's tie it all together and figure out what this actually means for the future of business and investing. So when you step back, here's the big picture. 1, the smartest investors are buying great public companies and taking them private to unlock their true potential. 2, Wall Street is building the trading floors to make these private assets easier to buy and sell. And 3, the firms themselves are inventing new tools, like CVs, to hold onto their crown jewels longer than ever before. The single most important thing to take away from all this is that we are literally watching the construction of a parallel financial universe. It's complex, it's sophisticated, and it's built for one reason: to create, grow, and capture enormous amounts of value before a company even thinks about going public. And all of this leaves us with one final massive question. As the best, most innovative companies are grown inside this powerful new ecosystem, are we entering a brand new era of investing? One where the biggest rewards are captured by a select few long before the average investor ever gets a chance to get in?